In recent times and even a number of years back, more malls and shopping outlets have been closing down. Why has this been occurring? Welcome to the TheBizPage channel. In this video, we will be looking at what the retail apocalypse is and how malls are being closed down over the year. If you haven't already, then be sure to leave a like on this video and subscribe to the channel for more valuable content. Now without further ado, let's dive in. The retail apocalypse is a term referring to the closing of numerous brick-and-mortar retail stores. This includes the closure of large chains worldwide. This trend started up around the year of 2010 and has been continuing ever since. In the year of 2019, a number of retailer stores closed in the United States. There were around 9,302 store closings for 2019, which is also a 59% jump from the previous year of 2018. The statistics for 2019 have been the highest number since the tracking of data began in the year of 2012. It is stated that over 12,000 standalone stores and outlets have closed due to a number of factors. These factors have included overexpansion, increases in rent price, companies filing for bankruptcy, low profits outside holiday seasons and delays in recovery from the Great Recession. From at least the year of 2010, the factors previously stated have resulted in the closing of many stores in countries such as the USA, the United Kingdom, and Australia. The department store industry has been most affected. The company of Sears is an example of what is currently happening. In the year of 2006, Sears owned more than 3,500 stores and had 355,000 employees recruited. However, 10 years later at the end of 2016, Sears operated only 1,430 stores, meaning they lost over half of the 2006 number. In October of 2018, Sears had filed for bankruptcy. Following this, they closed an additional 142 of their 687 remaining stores. During this time, Sears had 68,000 employees. The statement of the retail apocalypse became a popular saying in the year of 2017. The saying was more used as various companies announced plans to either stop trading or close down a number of stores. This included companies such as H. Gregg, Family Christian Stores and the Limited ceasing trading and business completely. Another name described for the closing of stores was the Great Retail Apocalypse of 2017. This came when 9 retail bankruptcies and several apparel companies had their stock prices go down. Credit Suisse, which is a major global financial services company, had predicted that 25% of U.S. malls remained in 2017 could be shut down by the year of 2022. Are you learning some new facts in this video? If you are, then be sure to leave a like and visit the TheBizPage channel for more content. For more information, then be sure to read the video description below. Here is a list of main factors that have been linked to the cause of stores closing down. The first factor is businesses are shifting to e-commerce and online basis. One of the main causes that has been seen in the closing of retail stores during the retail apocalypse is the movement as in where people prefer to do their shopping. In this instance, all the purchasing is moving towards online shopping. The sales during holiday seasons for e-commerce were reported to have increased by around 11% for 2016 compared to the previous year of 2015. This was reported by Adobe Digital Insights, with Slice Intelligence reporting a higher increase of around 20%. Comparing with the increase in online shopping, brick-and-mortar stores also had an increase of around 1.6%. However, physical and standalone stores experienced a 4.8% decline in customer shopping. The second factor is overmalling that took place in the early years of shopping. This factor takes into account of the oversupply of malls as the growth rate of malls in North America increased between the years of 1970 and 2015. It was said that the rate of growth was over twice that of the rate of the population growth. In the year of 2004, Malcolm Gladwell wrote that investment in malls was artificially increased and rose when the United States Congress introduced accelerated depreciation into the tax code in the year of 1954. However, even though new malls have been built with unique facilities and attractions, visits to the mall have decreased by around 50% between the years of 2010 and 2013. Each successive year that has passed, more declines in customers and revenue has occurred. The third factor is a term known as experience economy. This is considered to be a major factor and is also known as the restaurant renaissance. This is the meaning of the shift in spending habits that people have for their disposable income. This includes spending in clothing, dining out and travel. People are choosing to spend different compared to that of a number of years ago. The fourth factor is a term known as shrinking middle class. This is an interesting factor that not many people know about. It is relating to how most people are not only changing spending habits, but also their particular class. The reduced spending from the middle class has resulted in large-scale closures of retailers such as Macy's and Sears. Both of the mentioned companies relied on spending from the middle-class market segment. In the more rural and remote areas, stores like Dollar General and Family Dollar were once stated as being unaffected by any sort of recession or decline since both companies had success and have continued growing rapidly. However, both companies are looking to be in the decline. Along with this, a number of independent retailers have ceased trading over the years, due to being unable to compete with the lower margins that larger national chains have on offer. The fifth factor is poor management in business. A poor brick-and-mortar performance in terms of sales is caused by poor retail management and a lack of accurate inventory control. Both of these arising issues can result in underperforming and out-of-stock merchandise. This will then also lead to a poor shopping experience for any customers in order to optimize and achieve the short-term goals. This also creates the desire to have less employees in retail stores in order to raise the profits. Debt can also be an issue for many long-standing chain retailers. Debt occurs from leveraged buyouts from private equity firms, which hinders the profitable operation of retail chains. The fact that technology is moving on also influences the closure of malls and retail stores. It will be interesting to see what will occur over the next decade or so and where malls and retail stores will go. Be sure to leave a comment below on your thoughts. If you found this video interesting, then be sure to leave a like and subscribe to the BizPage channel for more valuable content. Thank you for watching.